Imagine for a second that you are invited to a game of chance. There is a room with 100 people. You are told that the average net worth in this room is $2 billion. Naturally, you think your odds are fantastic. You pick a person at random, hoping to trade bank accounts. But here is the catch. 99 of those people have exactly $100,000 in their pockets. The 100th person is Elon Musk. In this scenario, the average is technically correct, but the reality for 99% of the people in that room is that they are nowhere near that $2 billion mark. This is exactly what is happening every single time you try to pick an individual stock. You are looking at the historical 10% return of the stock market and assuming you can just grab a piece of it by picking a few good companies. But the math of the stock market is not a normal distribution. It is not a fair coin flip. It is a game of extreme statistical asymmetry, where a microscopic number of winners carry the entire team on their backs. If you miss those specific winners, you do not just underperform slightly, you fail catastrophically. Today, we are going to look past the Wall Street marketing and the flashy earnings reports. We are going to dive into the cold, hard realm of standard deviation and positive skewness to see why even the smartest people on the planet are mathematically destined to lose to a simple, unmanaged index fund. If you value your retirement, this is the most important math lesson you will ever take. Before we get into the heavy math, I want to make a quick observation about the world we live in. We are currently surrounded by what I call the financial entertainment complex. There are thousands of hours of television, millions of articles, and an endless stream of social media gurus telling you that you can find the next Apple, the next Amazon, or the next Tesla. It is an intoxicating narrative because it suggests that through enough research and grit, you can outsmart the system. I have spent years looking at these portfolios, and I have noticed something consistent. The effort you put in almost never correlates to the reward you get back. In most areas of life, if you work 10 times harder, you get a better result. In investing, the harder you try to beat the market, the more likely you are to fall behind it. This video is going to be a deep dive into why that paradox exists. If you find this kind of data-driven approach valuable, the best return on your time today is to stick around until we reach the Bessembinder study in a few minutes. It fundamentally changed how I view my own portfolio, and it will likely do the same for you. We are going to look at why the pros fail, how standard deviation acts as a silent killer, and why the most boring way to invest is actually the most elite strategy on the planet. Let us start with a reality check on the people who do this for a living. If stock picking were truly a skill that could be mastered with enough education and resources, we would expect the professionals to be crushing the market. These are people with Ivy League MBAs, Bloomberg terminals that cost $30,000 a year, and direct access to corporate CEOs. Yet, when we look at the SPIVA scorecard, which is the gold standard for measuring active management, the data is a total graveyard. According to the year-end reports, over a 15-year period, nearly 88% of all large-cap active fund managers in the United States failed to beat the S&P 500. When you stretch that out to 20 years, that number often climbs above 90%. Think about that for a second. If you went to a doctor and they told you that 90% of the people in their profession failed to achieve a basic standard result, you would never go back. But in finance, we keep giving these people our money. Now, the common excuse is that fees are the problem. If a manager charges 1% and the market returns 10%, they have to hit 11 just to tie. That is true, and that variance drag is a real problem. But even before you account for fees, the gross returns of these professionals still trail the index. This suggests that the failure is not just about the cost of doing business, it is a structural failure in the act of stock selection itself. The professionals are not losing because they are lazy or unintelligent. They are losing because they are fighting a war against the mathematical structure of the market. They are looking for needles in a haystack, and most of the time, they are not only missing the needle, they are getting poked by the straw. It actually gets worse when you account for what we call survivorship bias. When you look at a list of mutual funds today, you are only seeing the winners who lived long enough to tell the tale. A massive percentage of funds that exist at the start of a 10-year period simply vanish by the end of it. They are liquidated or merged into other funds because their performance was so abysmal that the parent company wanted to hide the evidence. If you adjust the numbers to include all the funds that died along the way, the success rate of picking stocks becomes a statistical rounding error. I have run these numbers myself, and it is shocking how much marketing goes into hiding the symmetry. We see the one fund out of 50 that beat the market, and we think, wow, they have the secret sauce. We do not see the 49 others that are currently 6 feet under. This creates an illusion of competence. It makes us think that because someone won, it was due to skill rather than the law of large numbers. But why does this happen? Why is it so hard to just pick the winners? To understand that, we have to move away from the charts and move into the world of statistics. We have to talk about the bell curve and why it is a complete lie when it comes to your money. Most of us are wired to expect a normal distribution where things cluster around an average. We think if we buy 30 stocks, some will do well, some will do poorly, and most will be okay. But the stock market does not follow a bell curve. It follows a log-normal, positively skewed distribution. The human brain loves a good bell curve. If you measure the height of 10,000 men, most will be around 5'9". You will have a few giants and a few very short people, but the average and the median will be basically the same. Because we see this in nature, we instinctively apply it to our portfolios. We assume that if the market's average return is 10%, most stocks will return somewhere near 10%. This assumption is the foundation of the stock-picking delusion. In reality, individual stock returns are wild and asymmetric. When we talk about standard deviation in finance, we are measuring how much an investment's returns disperse from its average. A high standard deviation means things are all over the place. For the S&P 500 as a whole, the annualized standard deviation is usually around 15 to 18%. That is manageable. But the standard deviation of an individual stock? It is often 40, 50, or even 100%. Individual companies are chaotic. They deal with scandals, failed products, and new competitors. When you own the whole index, these individual disasters cancel each other out. But when you try to pick 30 winners, you are exposing yourself to the full, unadulterated variance of individual equities. And because of positive skewness, that variance is not working in your favor. In a normal distribution, the middle point is the average. In the stock market, the massive winners on the far right side pull the average way up, while the median stock, the one right in the middle, actually returns almost nothing. This is the Elon Musk in the room problem, but with ticker symbols. Let us break down why this positive skewness is a mathematical death sentence for the stock picker. Think about the potential of a single stock. What is the worst that can happen? You lose 100%. That is your floor. You cannot lose more than you put in. But what is the best that can happen? The upside is theoretically infinite. A stock like Amazon or Apple has grown by tens of thousands of percentage points over the decades. Because the downside is capped at 100, but the upside has no ceiling, the return distribution gets stretched far out to the right. This is what we call a long right tail. When you have a few outliers that return 5,000%, they pull the average of the whole market up to 10%. But most of the stocks in that market are not returning 10%. They are returning 0, or they are losing money. I want you to let that sink in. If you pick a stock at random, the highest probability outcome over a long period is that you will make no money at all. You are essentially betting that you can find the 1 in 1,000 outlier that is doing all the heavy lifting. If you miss that specific stock, your portfolio's average will not be the market average. It will be much, much lower. This is why the pros struggle. They build a diversified portfolio of 50 stocks, But if they decide that the one stock that goes up 2,000% is overvalued and they leave it out, their entire fund is doomed to underperform. They are playing a game where missing one single answer out of 100 results in a failing grade. We are going to look at the study that proved this beyond any doubt. If you are still thinking that you can beat the odds, I need to tell you about Hendrik Bessembinder. He is a finance professor who published a paper that basically set the academic world on fire. He analyzed the lifetime returns of every single common stock in the United States from 1926 all the way to 2016. That is over 25,000 companies. His findings were the ultimate reality check. First, he found that over half of all stocks had a negative lifetime return. The most common outcome for an individual stock was a total loss of 100%. Second, he discovered that 96% of all stocks collectively performed no better than a one-month Treasury bill. That means you could have taken the money from nearly every public company in history, put it in a boring government cash account, and ended up with the same amount of wealth. Here is the kicker. All of the net wealth created by the stock market over those 90 years, $35 trillion, was generated by just 4% of the companies. Just over 1,000 companies created all the value. The other 24,000 were basically just noise. This is the 4% rule of the stock market. If you own the index, you are guaranteed to own that 4%. If you pick stocks, you have a 96% chance of picking the companies that perform no better than a savings account. When people talk about beating the market, they are talking about finding that tiny 4% before everyone else does. But when you consider that even the brightest minds on Wall Street miss them, you have to ask yourself, why am I taking this risk? We are going to talk about the agony and ecstasy of these positions next. To add some modern flavor to Bessembinder's historical data, we can look at a report from J.P. Morgan called The Agony and the Ecstasy. They looked at the Russell 3000 index from 1980 to 2020. They found that 40% of all stocks in that index suffered what they called a catastrophic loss. This is defined as a stock dropping 70% or more from its peak and never recovering. Imagine 40% of your choices just evaporating and never coming back. Meanwhile, the overall index was up massively during that same period. Why? Because the ecstasy stocks, the top 10%, performed so well that they made up for all the bankruptcies and all the laggards. This is where market cap weighting becomes your best friend. An index fund like the S&P 500 is a ruthless, emotionless momentum machine. When a company starts to fail and its market cap shrinks, the index automatically reduces its exposure to that company. If a company goes to zero, the index only loses the tiny fraction of a percent that it represented. But when a company like Nvidia or Apple starts to explode, the index automatically buys more of it as it grows. The S&P 500 lets its winners run to infinity, and it cuts its losers as they shrink. Most human investors do the exact opposite. We have a psychological urge to sell our winners to lock in profits and hold on to our losers because we don't want to realize a loss. This behavioral flaw is a direct attack on the math of positive skewness. To win the game, you have to hold the outliers forever. The index does this perfectly. You and I, unfortunately, are human, which makes us very bad at it. I hope this deep dive into the math is helping you see the market through a clearer lens. If you appreciate this kind of unsentimental, data-driven approach to money, I want to invite you to become a bigger part of this community. You can click the join button below to become one of the optimizers. Our members get a few cool perks, like custom sketch badges next to their names and priority replies to their comments. I try to get to as many questions as I can, but I always start with the optimizers because they help keep this channel independent and focused on the facts rather than the hype. It is a simple way to support the research that goes into these long-form breakdowns. But regardless of whether you join, I am glad you are here. We still have the most famous bet in financial history to discuss, which proves that even billionaires know they cannot beat the index consistently. Let us look at why Warren Buffett bet $1 million on everything we have just talked about. Warren Buffett is often cited as the ultimate proof that stock picking works. And yes, he is a phenomenal outlier. But Buffett himself would tell you that he is a rare statistical event. In 2008, he decided to prove the math of indexing to the world. He bet $1 million that a simple, low-cost S&P 500 index fund would outperform a hand-picked basket of elite hedge funds over a 10-year period. A group called Protégé Partners took the bet. They picked 5 funds of funds, which represented the expertise of hundreds of the smartest hedge fund managers on the planet. These were people using leverage, complex derivatives, and high-frequency data to gain an edge. By the end of the 10 years, the result was a total blowout. The S&P 500 fund returned an annualized 8.5%. The elite hedge fund managers? They averaged only 2.9%. Buffett won the bet without breaking a sweat. He did not win because he was smarter than the hedge fund managers. He won because he sat still. He understood that the index would naturally capture the massive right-tail winners, while the hedge fund managers were busy trading in and out of stocks, paying high fees, and missing the few companies that actually mattered. This bet should be the final nail in the coffin for the idea that active management is a superior path. If the smartest guys in the room, with all the money in the world, cannot beat a dumb index over a decade, why do we think we can do it on our lunch breaks? The answer lies in our psychology, which we need to fix if we want to actually build wealth. We have to learn to accept average as an elite result. The reason we ignore the math is usually due to 3 big psychological traps. The first is overconfidence. We all think we are above average drivers, and we all think we have a special knack for seeing which companies will succeed. The second is survivorship bias from the media. You never see a headline that says, "Man loses everything by investing in a boring industrial company that went bankrupt." You only see the stories about the 25-year-old who turned $1,000 into $1 million with Nvidia. This gives us the illusion that the outliers are common. The third is the illusion of control. We feel like we are doing something productive when we research a stock. Buying an index fund feels passive and lazy. But in the stock market, laziness is a superpower. Every time you trade, you are risking the chance of selling one of that 4% of stocks that will carry your retirement. The most important realization you can have is that in the world of investing, average is actually exceptional. Because of the way the math works, if you simply match the market return by owning an index, you will outperform about 90% of professionals over 20 years. You are not settling for a C grade, you are getting an A+ just by showing up and doing nothing. This is the ultimate emancipation for the retail investor. You no longer need to stress over earnings calls or watch financial news. You can acknowledge the math of standard deviation, buy the entire haystack, and let the massive outliers do the work for you. You are no longer a gambler, you are a collector of the world's most productive assets. That shift in perspective is the difference between a life of anxiety and a life of financial freedom. When we look at the math, the stock-picking delusion falls apart. Standard deviation shows us the risk of concentration. Bessembinder shows us that wealth is concentrated in a tiny fraction of companies, and the SPIVA data shows us that even the pros cannot find those companies consistently. The solution is to stop looking for the needle and just buy the haystack. It is simple, it is boring, and it is mathematically the most sound way to grow your wealth over time. I want to hear your thoughts on this. Have you ever had a stock that you thought was a sure winner, only to see it become part of that 40% catastrophic loss category? Or are you a die-hard indexer who has learned to love the average? Drop a comment below and let us do some peer review on these strategies. I read as many as I can, especially from our optimizers. Thank you for spending your time with me today. Stay smart, stay patient, and I will see you in the next one.